Hello everyone, welcome to today's US Open live webinar. It is Tuesday, November the 14th. I'm your host, Nikos Zabouras, Senior Financial Editorial Writer at FXCM. US CPI inflation was this week's main event, released just earlier today, and showed significant deceleration in October as today's data showed, sending the US dollar and treasury yields lower and Wall Street higher, allowing Wall Street to look past the Moody's downgrade and the prospects of and the renewed prospects of government shutdown. Meanwhile, oil prices rebound, partly helped from the US inflation figures and because OPEC and the International Energy Agency rose their 2023 growth outlook forecasts. Focus, of course, now shifts to the UK inflation figures, which are due on Wednesday, following today's wage data and the UK government reshuffle. That's what we will be talking about today. Before, however, we begin, as always, please read carefully through the risk warnings and the disclaimers. Once again, please read carefully through the risk warnings and the disclaimers, and please bear in mind that anything discussed in this session does not constitute investment advice. So I'll give you a few more seconds to do that, and we will begin after that. Okay, let's get the ball rolling. As I said, we're gonna start with Wall Street, with the Dow, a little bit different today. We're gonna talk about the inflation figures and their impact on the index. Then we're gonna move to oil prices, which rebound over the past few days, and then we're gonna move to Euro USD and round things off as always with what's ahead, including, of course, Wednesday's UK inflation update. And now to the US data. Inflation in the US moderated significantly in October, according to the data released just less than an hour ago. Core inflation ticked down to 4% year over year. That's the slowest pace in roughly 2 years, while the all-inclusive CPI is to 3.2%. Now, these data are definitely in the direction the Fed wants and play into the peak rates expectations. The Fed, of course, is unlikely to take a victory lap, so it will be interesting to see the comments from Fed officials. However, I'm still a bit cautious around the data, since October was accompanied by a significant drop in oil prices, which of course affects the headline figures. And there were also strikes in the big three automakers, which have now ended. In any case, markets cheered the soft inflation figures, and US 30 gains around 1% today. There were more good news last week from the corporate world, since Disney, the entertainment giant and a major component of the main index, jumped last week after encouraging quarterly results, which showed a return to subscriber growth and further cost cuttings. Of course, you can find detailed analysis on the FXCM market analysis websites of your respective regions. Now, given the above, the index tries to take out the September highs just above the 35K mark, but I'm still a bit hesitant. I believe it may need fresh impetus for greater gains that would challenge the 35,087 resistance. Now, despite today's surge, and of course, it has regained the initiative a few days ago, but the relative strength index has moved now to overbought conditions, while there are a series of negative news, mainly the fact that Moody's downgraded the US rating outlook to negative, and there are also renewed prospects for a government shutdown, which may weigh. That hasn't happened so far, but these are some risk factors that could potentially put pressure. A return back towards the 200 period EMA at around 33,800 to 33,600 roughly would not be surprising, but strong catalyst would be required for daily closes below that region, which could of course pose the bullish bias. Now let's talk about US oil. It comes from 3 straight losing weeks. That's the worst streak since April, as the Hamas-Israel war has not spilled over. It seems that markets are, let's say, cool about it, and instead they have focused on demand fears. However, OPEC said that negative sentiment is exaggerated, and I have said about that this negative sentiment is a bit stretched. I have talked about that in previous sessions, and both OPEC and the International Energy Agency raised slightly their 2023 growth forecasts. And of course, this has helped the rebound we see over the past few days in oil prices, and today's inflation figures are also supportive, since they lowered chances of another hike by the Fed, which could create a recession or an economic slowdown. As we said, the commodity rebounds over the past few days, but the technical landscape is a bit tough. Although there is room for further gains towards the 200 period EMA, close to the $83 mark, there are multiple hurdles above that, as you can see on the chart. The path of least resistance at this stage is lower, and as such there is risk for renewed pressure back towards the 72.23 support, and the next comes at 66.78. And now let's go to Euro USD. You can see this big jump today. The pair had clinched new highs after the poor NF freeze a few days back, and now breaks fresh ground with the impetus taken from the inflation report. It finally moves away from the daily Ichimoku cloud and brings the 50% Fibonacci in the spotlight, located at 1.0959. But I'm still a little bit weary of sustained recovery, and that is because although today's inflation figures reinforce expectations for peak rates by the Fed, there are such prospects on the ECB side as well, because it paused after 10 consecutive hikes, and although it has not shut the door to further tightening, Eurozone and its economic engine Germany are going through a slowdown, a contraction in GDP and poor PMIs, and there's also a significant drop in inflation. Headline, according to preliminary data, dropped below 3%, and of course we expect later in the week the final figure. So this could be supportive. This could keep ECB officials on the sideline and are not supportive of the common currencies ascending prospects. Now we're gonna need to see how the move evolves, because we're just 1 hour since the US data, but there is still risk for pressure back towards the 200-period EMA, but the 2023 lows are now distant. And now let's talk about what's ahead. We have UK inflation update on Wednesday. Inflation has dropped significantly from its multi-decade peaks around a year ago, and the BOE expects to continue to fall sharply. However, the last few couple of prints have shown persistence, and the bank does not project it to fall below the 2% target for another 2 years. Policymakers have stood pat for the last 2 meetings, but they may have a hard time staying in the sideline given this outlook. Earlier today, wage growth showed further easing but limited, and remains very high, in a constant headache for the central bank. On Monday, we also had a government reshuffle only a year into Mr. Sunak's tenure, and the return of former PM David Cameron, who held the 2026 Brexit referendum, was one of the notable changes. Of course, this didn't do much for the stock market and the pound, but it goes to show that there is still uncertainty and political drama in the UK, which is never good for sentiment. Now we also expect employment data from Australia tomorrow. We expect the Q3 wage price index. Wages have been rising for the past several quarters in Australia to 11-year highs in Q1 before marginally easing in the last print. This creates pressure to inflation, although it's too low for any wage price spiral. October employment change comes then on Thursday. The last print was quite poor, but unemployment had dipped down. In any case, the labor market is still tight despite signs of cooling. The central bank raised rates, we talked about it, to the highest levels in 2022 years last week, after 4 straight meetings on the sidelines, worried about slower than previously thought progress on inflation. We also expect Chinese President Xi meeting with US President Biden this week at a period of broad Sino-US relations and Sino-Western relations in general, with trade curves on both sides. And of course, with conflicts in Ukraine and the Middle East, everything could be on the table. On the earnings front, we expect US retailers like Target and Walmart. China comes into play, starting with JD, the retail and tech giant, which recorded a record Singles Day, the promotional event in China. And we also, one of the highlights for me is the upcoming results from UK luxury fashion group Burberry. So that's what I will be looking over the following days. That's it from me for today. We're going to talk again on Thursday at our usual time slot, 10 minutes before Wall Street opens. Thank you for joining me.